Hello everyone, Phil Hodgen here. This is the Hodgen Law PC International Tax Lunch for April 17, 2020. We do this every month on the second Tuesday of the month, noon Pacific time, so dial in. If you're listening already, you know how to get here through CalCPA. You're either on their list or on our list, and if you want to be on our list, go to hodgen.com/newsletters and sign up for the list that you want to be on, and you'll get notification by email of the upcoming topic and how to sign up and all that fun stuff. Later, we're going to put this on YouTube. You can watch it for free, and there is no quiz later, so watch it with a glass of wine. This month's topic is the Foreign Earned Income Exclusion, Form 2555. This one is kind of interesting in that it presents a great opportunity for a lot of people, but it's also full of assumptions that are frequently wrong, and there's less than meets the eye for a lot of people. People think it's a panacea, and it sometimes isn't. The biggest problem I see is people who are living abroad have heard vaguely about this thing, and they're making $50,000-$60,000 a year. They hear, I can avoid income tax on $100,000 a year or so of income because I'm working abroad, therefore I don't even have to file. Well, no, that's not exactly right. And that's one of the biggest problems, and as we'll note at the end, you can fix these as long as you get to the IRS before the IRS gets to you. Anyway, let's talk a little bit about the details, how it works, who qualifies, and all that fun stuff. So, Part 1, Introduction. Here is the game we're playing. These are the cookies we want. We are going to exclude from gross income and exempt it from taxation some kind of income. It's foreign earned income, and we'll talk about what that means, but this is cool because you can make a buck and not pay tax on it. Here are the amounts that we're playing for, the maximum amounts that you can exclude from your income every year, and I've got these from 2017 all the way through 2020. And you can see it increases every year a little bit for inflation. Now, in addition, I'm going to be talking about foreign earned income today, but there's another exclusion that goes along with it called the housing exclusion for housing costs. So let's say your employer abroad pays for an apartment and you live in it. Well, that's income in the eyes of the IRS, but you can exclude some of that. The amount that you can exclude varies by physical location. The easiest way to figure out how much you can exclude is by looking at the instructions to Form 2555, and they list a whole bunch of cities across the world and how much the maximum you can exclude in those situations. If you're self-employed, you don't have a boss who's paying for the apartment rent, you're living abroad, you can take a deduction instead, and it amounts to the same thing. But for simplicity for the rest of this program, I'm just going to talk about the foreign earned income exclusion. So how do you earn some salary and not get taxed? How do you get some self-employment income and not get taxed? And just understand that along with it, there's the possibility of this person, the taxpayer, excluding some housing costs as well from taxable income. This is the little slide from the Publication 54. Publication 54 is all about U.S. residents abroad and taxation, and I've annotated it helpfully so that it mimics the sections of this speech, and also so you can sort of see the sections of this talk are highlighted in the little dots, 1, 2, 3, 4, and the little things that look like pills are cross-referencing to the different parts of Form 2555. So you can see, and the problem I have with this is it's a flow chart that sort of ends up like a whirlpool in the middle, and you're stuck there. It's not the most aesthetically pleasing flow chart in the world, let me just say. But I do not judge. There are 4 requirements you're going to have to meet if you want the foreign earned income exclusion. They break out into 3 categories. Are you the right kind of person? Do you have the right kind of income? And did you do the right kind of paperwork? Now, the first thing, are you the right kind of person, actually has 2 parts to it. This tax home part and this second one, bona fide residence or physical presence test. The second one is the right kind of income is foreign earned income, and the third one is the paperwork, which is easily accomplished by actually filing the Form 2555, and you're done. And this is going to be the layout of the presentation from here on. I'm going to talk about what it means to be a qualified individual. How do you qualify? Then we're going to move on to foreign earned income. What is that and what does it mean? And furthermore, how much can you exclude once you've decided that you have some foreign earned income? And finally, we'll talk about the paperwork, not so much about filling it in line by line, because it's a fairly mechanical kind of piece of paperwork. It's not a difficult form to fill out, but mostly for what's the filing deadline, because as often as not when I'm talking to people about the foreign earned income exclusion, they're late and they want to go back in time and exclude some income and thereby reduce some tax liability in the past. So we're going to talk about filing deadlines. So let's start off with, are you the right kind of person? The code calls this person a qualified individual. And a qualified individual is somebody who has A, tax home outside the United States, and B, meets one of these two tests: the bona fide resident, I really truly live in that foreign country, or physical presence. Yeah, I spent at least 330 days out of the last 12 months in a foreign country outside the United States. So those are the two things that we have to satisfy to become a qualified individual. So let's take a look at those. The first one is the tax home test. And this is just a mess. There are two concepts here that you're going to have to wrap your head around, one of which is the tax home, and the other one is the abode. If you think about tax home, think about this as your place of business. And think about the abode as where do you really truly live. So in tax language, kind of what's your domicile. And the tax home is pretty easy to understand if you think about travel expenses. When do you get to deduct expenses for traveling away from business? Well, if you're driving from home to your office, that's a commuting expense. It's not a travel expense that you can deduct. If you're going from the office to the airport and the airport to Nashville and things like that, those are deductible expenses because you're on business away from your tax home. So just sort of think of the tax home that way. What's your place of business? And the abode is, where do you live, really truly? Do you have a house? Your spouse and the kids are still there, and the dog, and your car's registered there, and you're registered to vote, and you got a driver's license and all that fun stuff. There's no magic bright line, but it's a sort of touchy-feely thing. Where do you live, really truly? Here is my flow chart to kind of describe how it works. And so this is, I'm judgmental about the IRS and their flow chart in publication 54. Here's my shot at it. So where do you live usually? So let's think about it first just in terms of, where's your home? And you answer that in one of two ways. Either you have a permanent place to live, an abode in the United States, or you do not. If you have a permanent place to live in the United States, it's game over. Your tax home is going to be in the United States. On the other hand, if you do not have a permanent place to live, an abode in the United States, then we go on to the next step. Like, where is your fixed place of business? This travel expense deductibility question that we talked about. And there are three possible answers to that. My fixed place of business is in the United States. So this is Phil with an office in Pasadena, California, but he's spending the next 4 months in Bangkok working on something, right? It'd be a nice way to live. In that case, my fixed place of business is really the office in Pasadena, California. So even if I sell the house, move the wife and kids and the dog and everything to Bangkok with me, so I don't have an abode in the United States, I still have a fixed place of business in the United States, and therefore my tax home is here, and I do not get to exclude the income that I earn while I'm working in Bangkok. The second possibility is that my abode is outside the United States, and my tax home, where I'm really truly working, is in a foreign country or multiple foreign countries. Doesn't really matter. In that case, my tax home is going to be in a foreign country, and I've successfully leaped over the first hurdle to become a qualified individual. The third possibility is someone with no fixed place of business, digital nomad. This is someone where there's no office to go to. You're making your money sitting in a coffee shop somewhere in Chiang Mai, and you just work on your laptop and you make money. And after 30 days, you pack everything in your backpack, move on to Cambodia, and you're there for a while. And then you move on to Vietnam, and you're there for a while. That kind of lifestyle. In that case, your tax home is going to be wherever you are. Since you're in a foreign country, your tax home is outside the United States, and therefore you've got the green light. The first step of becoming a qualified individual, your tax home is outside the United States. And here's the rule. I mean, if the case law in the United States comes more with traveling consultants or truck drivers or something like that. Easiest example is to think of a truck driver who sells the house, puts the money in the bank, and just starts driving cross country, living in the back of the cab. It has no fixed place of residence, but I'm driving wherever I drive. That's my home, and it's my truck, and I'm contracting out to other people to haul stuff from A to B. In that case, you don't have a principal place of employment. There's no boss. I'm my own boss. And I don't have a permanent abode. I don't have an apartment or a home anymore. Therefore, my home is wherever I am, like a turtle. So this is really this final summary. We'll go back to the diagram that I did before. In my experience, this is going to be the first and hardest hurdle to hit, because anyone who is being audited for this, the first thing the government is going to look at is, where is your abode? And if you have something that looks like a footprint in the United States, you're going to be probably shoveling snow uphill in hell in the summertime to try and persuade the government that your tax home is outside the United States. And up until, I think it was 2018, this was the problem for government contractors who were working in Iraq and Afghanistan and places like that. They would still have family and house in the United States, but they'd be working, and they'd be full-time or close to it, in Iraq and Afghanistan, and they would claim the tax home is there, and the government would say, no, you've got a real home there, and you're paying a mortgage, and your kids are in school, and you've got a dog and a speedboat and all that fun stuff, and therefore you still have an abode in the United States. And they'd lose. Most of the cases they lost. A few of them they were lucky and they won, but for the most part they would lose these cases. And in 2018, I think it was 2018, there was a special law passed in Congress that said, well, if you are working in a combat zone that's designated by some sort of proclamation, I forget exactly what, then it doesn't matter whether you have a home in the United States or not. We're going to allow you to be a qualified individual, and we're just going to look at your fixed place of business. So for someone like that, you're a government contractor, you still have the home in the United States with the family there, but you're spending 12, 14, 16 months in Iraq and Afghanistan or wherever. Your fixed place of business is there, and you do get to become a qualified individual for purposes of the Foreign Earned Income Exclusion. But anyway, this is the soft spot, in my opinion, for any audit for the Foreign Earned Income Exclusion. Here's my little handy-dandy summary table so you can look at it, which compares where is your regular place of business, inside or outside of the United States, or nowhere, and where is your abode, inside, outside, anywhere, nowhere, and then what your conclusion is, where is your tax home, that's the third column, and can you be a qualified individual, highlighted green for the answers of yes. So that's the first part, tax home. Take care with that and make sure that if you want to claim the Foreign Earned Income Exclusion, paint the picture in favor of you having no tax home in the United States. The second barrel of this double-barreled shotgun that you need to shoot off in order to become a qualified individual is this thing of qualifying either as a bona fide resident of another country or satisfying the physical presence test, which means you spend most of the year outside of the United States. So again, remember, qualified individual means foreign tax home plus one of these two things. Now, the first question is, which one of these two can you use? And the answer is, for U.S. citizens, you can use either of these, either the bona fide resident test or the physical presence test. But a green card holder is only going to be able to use the bona fide resident test if he or she is living in a country for which he or she has a passport, right? So you have a UK citizen who gets a green card, returns to the United Kingdom, and is living there and working there and decides to take the foreign earned income exclusion. It will work. On the other hand, that same UK citizen with a green card goes to Dubai for 2 years to work, wants to claim the foreign earned income exclusion as a bona fide resident of Dubai. It will not work. So this is the critical test. So if you have someone that you're preparing a tax return for and is a green card person, pretty much assume that you really want to rely on the physical presence test and make sure that this person stays outside of the United States for the correct number of years, not years, days, within a 12-month period. So now, having decided you're going to pick one or the other, maybe you qualify for both and you're going to decide which one you want to choose to put on the Form 2555. Let's talk first about the bona fide residence test. Here is the part of the Form 2555 Part 2, where you fill in all of your answers to the bona fide residence test. And this is really an essay answer. So if you think about tax law, there are really two types of laws, or questions that you have to answer if you want to figure out what you're supposed to do. One of which is a sort of an analog one. It's a touchy-feely, all the facts, do I meet the facts? If so, I win. The other one is a digital one. It's a very binary. If I spend a certain number of days in the United States as a non-resident alien, then automatically I become a domestic taxpayer. It says strictly count the days, the light switch is on or off. This is the analog kind of test, so it's a touchy-feely thing, and you want to make sure that you line up all of the facts in your favor, because what you think, I really truly live here, an auditor might not. And so taking this position, you want to make sure that the facts are strongly in your favor. Most of the time they are, but sometimes you're on the edge, and I'm going to tell you that if you're on the edge, look at the physical presence test, because it's much easier to definitively prove that you are outside the United States for X number of days than it is for you to have an opinion that I really live in the Dominican Republic, and a revenue agent says, oh no, you don't. So here are a bunch of factors that come from a case from 1962, and tax courts follow along these to this day, so you can kind of see all the stuff that you want to think about. It's kind of like the state of California has a domicile test for are you a California resident. This is the same kind of test exactly here. So all I can say is be careful and make sure that you're right, because the downside of getting this wrong is lights out or lights on. So if you can persuade a revenue agent that you are a bona fide resident, you get to exclude your foreign earned income. And if you get challenged on this and lose on audit, you're going to go from zero tax to whatever the tax is on $100,000 of salary, which is going to be a substantial swing. So it's a risky business thing to get wrong. Now, in order to claim the bona fide resident test, you have to be living outside the United States as a bona fide resident of another country for a full calendar year. So what happens if you move abroad June, right? So you've got June to December of the first year you're living abroad. You're really truly living in France or Germany or whatnot. You're there. You bought a house, kids are in school, the whole bit. But you haven't been there a full calendar year. Well, what you have to do in that case is you file Form 2350. You get a really, really long filing extension for that first stub year when you were a bona fide resident of the other country. And then once you're able to prove that the following tax year you were a bona fide resident all year, then you can use the bona fide resident status for that stub year, the first year you moved abroad. So just watch that this is the first calendar year is going to be tricky. You may end up using the physical presence test, counting the days, to get exclusion for that first year, or you might do the very long extension to claim the bona fide resident test. But here's my warning to you. Again, this is on the bona fide residence test and indeed the tax home. You want to be sure that the facts line up, because the last thing you want to do is put your head in the kitty's mouth and say, nice kitty. It might work out, it might not. So, having gone from the touchy-feely mumbo-jumbo kind of test of the bona fide resident test, let's move on to the much more bright line test of the physical presence test, because this is count the days, look at a 12-month period, thumbs up, thumbs down. You spend enough days in foreign countries or you didn't. And if you did spend enough days in foreign countries, you win. Here's how to do it. And here's one of the little subtle problems that people have if you learn about the Foreign Earned Income Exclusion at a cocktail party. This will be one that you don't quite get. It's not a 365-day period. It's not a year. It's not a tax year. It's any 12-month period. So start any day, roll forward 12 months. That's your time period that you've got to identify. You call it a qualifying period. And then within that 12-month zone, the qualifying period, you look and you say, how many days did I spend, full days, in a foreign country or multiple foreign countries? And at least one of those days has to touch the current tax year, the one that you're preparing your tax return for, but only one day. So once you've decided I have a qualifying period, and once you've figured out that you have 330 or more days in foreign countries, that's all you need to satisfy the physical presence test, and that plus the tax home abroad makes you a qualified individual. So this is where it goes on Form 2555, Part 3. So you can see that you're going to tell the government where you were and what you were doing, and in column D, you're going to list the full days present in the country outside the United States where you were. And by God, that better total up at the bottom to 330 or more. In fact, I'm proud to say I had an audit once that totaled up to exactly 330, and we won. So, but don't cut it that close. And you can see on line 16 where I've got the red box around it, that's your 12-month period. So you just have to give the government a 12-month period like that, starting date, ending date, and then you total up your days down below. So here's my little diagram that shows why even one day will make you a qualified individual. Here I have my qualifying period starting January 2 of 2018 and running until January 1 of 2019. And we're trying to decide here whether, when we're preparing the tax return for this person for 2019, is this person a qualified individual? Well, let's assume that he or she is someone who has a tax home outside the United States. So the next question is, did this person meet the physical presence test? Well, we've got this 12-month period. We've got 330 days outside the United States, and at least one of those days touches the current tax year, and we win. This looks a little bit weird because your brain immediately jumps to, wait, how much can I exclude? And so think of this in two steps. First, I just want to be a qualified individual. Once I've decided that, I'm going to move on to the next step, which is how much income can I exclude? And that definitely is a function of how many days in the United States, in the current tax year, you were a qualified individual. So that does function as it creates a fraction that we'll talk about in a bit that you multiply. So the counting days, here are the rules. The most important thing is to look at the regulations and the publication 54, which talks about all the gruesome details about what happens if you fly over the United States, so you're technically in the United States, but you're in the air and you never touch down. What happens if you touch down and you're in transit at an airport for 8 hours, 2 hours, 26 hours? What happens if this? What happens if that? All of these stupid things. What's a foreign country? Foreign country, not everything outside the borders of the United States is a foreign country. International waters is not a foreign country. Antarctica is not a foreign country. There are a couple weird places on the globe that are not foreign countries. So the edge cases are endless. Fortunately for most of us in tax practice, we don't live in edge cases. We live in reality with normal people and doing normal stuff. So let's just wrap up here on the qualified individual thing. You meet the tax home test, and you meet either the bona fide residence test or the physical presence test, and you are a qualified individual. And let's move on then to, now that we know I'm a qualified individual, how much income can I exclude? And there we go. How much income can I exclude? Well, the first question is, do you even have foreign earned income? Because the exclusion only applies to certain types of income. If you have $100,000 of salary that you earned while you're working away at an office job in Bangkok, that's foreign earned income. If you also have $2,000 of interest income because you had money sitting in the bank, that is not foreign earned income, and that does not get excluded. So let's just look through and see what foreign earned income is, and then we'll talk about how much can be excluded. So foreign earned income, so we've got income, which is the noun, and we've got two adjectives in front of it, foreign and earned. Foreign comes from, where was your body physically when you were doing the work? So were you in a foreign country? If so, it is foreign income. This is standard source rules. Earned income. Earned income comes from doing work with your brain or body. So if the money that you got is attributable to services you performed for somebody else, then it's earned income. Put the two together, so you worked abroad, you earned some money because you did some work, and that is foreign earned income. Now there's one more qualification. That's kind of standard just classification of source rules and what type of income rules in the tax code. But for the foreign earned income exclusion, we only care about foreign earned income that you earned while you were a qualified individual. So it's not only being outside the United States and working, it's being outside the United States and working while you're a qualified individual. So here's the little quote from Form 2555 instructions, and you can see the important thing bolded here, that we've got to make sure that not only did you make a buck while you're working in Bangkok, but you made a buck while your tax home was outside the United States and you met one of these two tests. Here's the little bit from Form 2555 where you collect all of the information about all of your foreign earned income of various types or another. You can see fringe benefits, and they're trying to pull everything out. So you can total it up below on line 26. So and remember, this is a gross income thing because the foreign earned income exclusion applies to gross income. Let's go back to the physical presence test, and I want to call out a couple of things in part 3 that can trip you up and will definitely be a place where a revenue agent is going to look if you have an audit like this. So you see on line 18, column E, number of days in U.S. on business, and F is the income earned in U.S. on business. This goes back to the question of, is it foreign earned income? So think of it this way. You have a salary of $100,000 and you're working for a random corporation in Bangkok, and they send you to the United States, and you have 10 working days in the United States while you're working and earning a salary. Well, those 10 days, where was your body? In the United States. Therefore, it's not foreign earned income. So what we have to do there is do some sort of magic math to figure out what 10 days worth of salary is worth on your $100,000 of income, and report the number of days in column in column E, and then the fund calculation in column F. And they ask you to attach your work papers so they can check your math and maybe challenge the way you did the proration. So back to this question of you made money while you're a qualified individual and you made money while you're not a qualified individual. So on the left, we've got the calendar year 2019, and in beautiful green, we have a time period. Person is working abroad and is a qualified individual. And so for half of the year, qualified individual. For half of the year, not a qualified individual. So perhaps the person failed the qualification because they blew the physical presence test or something like that. What it means is that only the income earned during that first 6 months of the year will qualify as foreign earned income to be excludable. So watch out for situations like this. Also watch out for, I've got income and it kind of looks like services, but it's not. So S corporation, and I've had many of these where Americans are living abroad, they have a domestic S corporation. They pull a salary, and of course they take a distribution. Well, is the distribution earned income or not? Answer, not. Another one is sole proprietors, where capital is important. You're a farmer, right? You've got a tractor, and without the tractor and the land, you ain't making no money. In that case, the gross income, the government says the maximum amount of gross income that you can exclude will be 30% in a situation like that. And there's the citation to the regulation. Now, foreign earned income exclusions for self-employed. These are a little bit weird and counterintuitive. And I confess that when I first started coming across foreign earned income exclusion situations and started learning about it, I had it all wrong in my head. So I'm going to show you where I started off wrong and then what it really looks like, because I started off from what I wished the answer was, and then I came around to the conclusion after reading the law carefully and thinking about it to how it really works. And maybe some of you are faster than me, but it took me a while. So the two key points for you to remember on this are that the foreign earned income exclusion applies to gross income, not net income. And remember, self-employment income is a net income calculation, gross revenues minus deductions. The second thing is that deductions that are associated with the excluded gross income for this self-employed person are disallowed. And the easiest way to understand that is think about, you have millions of dollars in the bank and you hire someone to be your investment manager. So they take your millions of dollars and they promptly buy a whole bunch of muni bonds which generate tax-free interest income to you. Question is, can you take a tax deduction for the management fees that you paid to this person? Answer, no, because the Internal Revenue Code says you can't take a deduction for expenses that didn't generate taxable income. And in this case, if a deduction generated income that's excluded by the foreign earned income exclusion, you can't take the deduction for that expense. So that's the combination of these two things is going to show you how it all works. So this is the wishful thinking picture, and this is what I first thought when I came across all this stuff. So let's say you're a random Schedule C person. You have $150,000 gross and $50,000 of regular business expenses. So your Schedule C income is $100,000. Hand wavy, cocktail party, tax advice. Oh, I can exclude $107,000 in 2020. I don't have to pay any tax. That's the assumption. That's what we'd like to believe, and it would be wonderful if it worked like that way, but it doesn't. So here's how it really works. I'm giving you the summary numbers here. We've got some excerpts from a sample tax return, and for those of you listening along, you got an email with a PDF of the sample tax return, the whole thing, so you can see how all the bits and pieces come together and how the numbers were calculated. And if you're listening later to this, my email is on the last slide of this. Send me an email and I'll send you a copy of this tax return. Oops, there we go. All right, so I'm going to walk you through these numbers. You see we have the same starting point where we have gross income of $150,000, we have business expenses of $50,000, and Schedule C income of $100,000. All right. What is the exclusion that we're allowed to take? Well, let's start with the maximum exclusion allowable, $105,900, and I'm pretending that we're preparing the 2019 income tax return right now, so that's where that number comes from. Now, we took $50,000 of business expenses to calculate Schedule C income, but how much of that is related to the gross income that's excluded, and how much of that is related to the gross income that's taxable? Well, handy dandy math, and you'll see this on the statements to the sample tax return, is that we have to add back in. We took a deduction of $50,000 for expenses. We have to add back $40,288. And just highlighted in case you're too bored to look at a tax return statement, this number comes from the fact that we had $50,000 of deductions. We also had the self-employment deduction. You know, you get 50% of the self-employment tax deduction, and you do some magic math, and this is the number that comes out. So at the end of it, we have the maximum $105,900 deduction because we had $150,000 of gross income, so well above the threshold. But we have to add back some expenses, and so we came with a net foreign earned income exclusion of $65,612, which means taxable income of $34,388. So that's how the math really works. So the bottom line for people who are self-employed is that the foreign earned income exclusion is not going to zero out taxable income. Here's some excerpts from the sample tax return that you can get or you already got. So let's start at the beginning. Part 4 of Form 2555 says, what's your total gross income? And so we've got $150,000 on line 20A for the gross income that shows up on Schedule C. Then Part 7, we're trying to figure out what's the maximum that we can exclude. And you can see this is a function of days in the year. And I've assumed that this person lived outside the United States for the entire year, so 105,900. And then Part 8, the line 44, is the add back or the reduction in the amount of maximum exclusion, the 40,288, resulting in the foreign earned income exclusion on line 45, which we port over to Schedule 1, and then we port it over, do the math in Form 1040 under the new style of 1040s, which are frankly an abomination unto the Lord, and we should quench it with fire, but that's just me. Schedule 1, this is where it shows up. So we had our Schedule C income, line 3, $100,000 as usual, and then line 8 we had the foreign earned income exclusion minus $65,612 equals additional income of $34,388, which goes over to line 7A of Form 2040 into gross income, and off it goes for calculating your actual income tax. The other important thing to remember is self-employment tax. Even if you can magically zero out or largely zero out your income tax liability as a self-employed person, the foreign earned income exclusion does nothing to the self-employment tax. So you're still going to owe that, whatever it is, on whatever your self-employment income is going to be. Right, now that we've decided we have some foreign earned income, now the next question is, how much can we exclude? And we did a little game with self-employed people already, but let's talk about this proration based on the number of days in your qualifying period compared to the number of days in the tax year. Again, we start with the maximums. It says, you've got somebody who's making $200,000 a year and living abroad and says, wow, I can exclude 107,000 in some this year, which means my taxable salary is only going to be 93,000. Well, not quite. Maybe, but not quite. We've got to do some more math first. The amount that you can exclude is prorated, and there's a fraction, and the fraction is, on the numerator side, the number of days in the current tax year that you are a qualified individual, and the denominator is the number of calendar days in the year, 365 or 366. So you're going to multiply that fraction times the statutory maximum, and that's going to be the actual amount up to which you can earn. So here's a simple example. Somebody who's been living abroad for years and years and years, and so they've been outside the United States for 12 months. The qualifying days are going to be 365, the numerator. The total days in the tax year 2019 are 365. So there's your handy-dandy math on the bottom bullet point. If 365 over 365 equals 1, 1 times 105,900 for the calendar year equals the maximum possible foreign earned income exclusion you can take on your 2019 tax return. So if you earned $105,000 of foreign earned income, you exclude all of it. If you earn $106,000 of foreign earned income, you exclude 105,900 and you're taxable on 100. If you're a part year foreign resident, so this is like the year you move abroad or the year you come back. Let's take an example of someone who moves out of the United States and starts really truly living outside the United States on March 1 of 2019. So what's the maximum exclusion amount that this person can take? Well, it's 365 days, this is the numerator, minus the number of days in January and the number of days in February. And that's your numerator, and you divide it by the denominator, number of days in the tax year. You do the math, and the maximum excludable amount is $88,782. And the important point is those $88,872 have to be earned after March 1 while this person is outside the United States. Now, you can overlap 12-month testing periods. So you might have one that starts in October 1, and you might have another one that starts in February 18 of the following year. So you can stack these things as much as you want and kind of think about these as little roofs, and you're just going to have one layer on top of another like shingles until you've got full coverage. So to the extent that you can, do that. And the way I do this is I set up a handy-dandy spreadsheet with the full calendar year before the tax year I'm doing, and the tax year after. And the first column is days, starting with January 1 and ending December 31 of each of those 3 years. And then the next column will be full days outside the United States. And so you can just do a simple, drag your mouse and highlight enough rows, and you can see when you get 330, and you can start to count, you can start to make multiple 330 out of 12-month testing periods to make yourself, boy, the words are hard. You're trying to make a qualifying period, and you're trying to use this to find all of the times in which this person was outside of the United States for 330 calendar days, full days, in that 12-month period. Anyway, email me if you want to talk about this further and how I do it. It's kind of hacky, but it works, and I've successfully shown these things to revenue agents and passed muster on them in terms of persuading them that this is indeed a qualifying period. And gaps are not fatal. So you look at this, you got somebody who comes to you for a tax return and says, I was successfully using the physical presence test all along, but I spent 6 weeks in the United States in the middle of the year because of reason X, and therefore I've blown it. Well, not exactly. If you can show the 12-month physical presence testing period for up to that time, and then another one starting 45 days later, now look what you've done. You've got qualifying days at 320 out of the 365, so you can still claim $92,844 of maximum foreign earned income exclusion for the earned income during those periods that are covered by those testing periods. So play with the dates a little bit and watch what people do moving in and out, and you may be able to salvage something out of the mud, even though it looks initially not very plausible. All right, let's move on to the final part, which is the paperwork. So you remember we had to have a person who's the right kind of person, a qualified individual. We had to have the right kind of income, foreign earned income, and we figured out what's the maximum we could take. Well, in theory, whatever they put in the RevProc every year, but in fact less than that for most people because of this prorating game. And then the third part is the paperwork, filing the Form 2555. So the important thing to remember is this is an election. You do not get the benefit of the exclusion unless you make the election. And the way that you make an election is by filing a piece of paper and telling the IRS. And the way you make this election is by filing Form 2555, which is bolted to a Form 1040, which you file. And so what do we do for people who are living abroad, non-filers, because they thought they didn't have to for one reason or another? How can you dig that out of the mud, file some late tax returns, and claim the foreign earned income exclusion to soften the blow of whatever tax liability they'll have? Well, here are the deadlines that we face. So the first thing to do is we've got to figure out, is a tax return timely filed? Because, the general rule for everything is you file on time, everything's cool. You're late, things are not so cool. So here is what file on time means. And there are a bunch of different rules, and I want to highlight the one in the middle, July 15, 2020, just because the early part of the year 2020 is weird because of the coronavirus fantasies that we're having, and not so fantasies, they're actually real. But the IRS has published a series of notices that have said if you've got any tax deadline that is due between April 1 and July 15, the deadline is now July 15 for those. So for most people, filing deadlines are going to be July 15. October 15 is the extension deadline. December 15, for people living abroad, you can send a letter to the IRS and you get 2 more months. And then again, Form 2350 is kind of roll your own deadline, and I'll highlight that in just a little bit. So what happens if you missed the deadline? The first column, the first row is you didn't file your Form 1040 on time, but you're less than 12 months late. There are 2 factors. There's one key factor, let's put it that way, of whether you're going to be safe or not, and that's going to be the question of when you file that tax return, is there tax liability, yes or no? So the first one is if you're less than 12 months late with your original tax return, doesn't matter whether you have tax due or not, your Form 2555 is going to be a valid election to claim the foreign earned income exclusion. The next one is what happens if you file your first tax return late and it's more than 12 months late? Well, if you are more than 12 months late but there's a 0 tax liability on the tax return, then your exclusion is a valid election. On the other hand, highlighted in sort of ugly yellow, what if you are more than 12 months late with your original Form 1040 and there is a tax liability with the tax return? Then, in that case, your election is valid or not valid depending on a foot race. If you get a Dear John letter from the IRS thinking of you, by the way, what's going on with this tax year, you're kind of out of luck. If you get your tax return filed first, however, then your election is going to be valid. So the moral of this story is, if someone wakes up and they realize they're a non-filer, they further decide that the foreign earned income exclusion would be highly valuable, then in that case, it's now a rush. Do not procrastinate any further. Do your tax returns and file them ASAP before you get the IRS burping out notices to you because you didn't file for that year. The final one is the amended tax return. So if you filed a tax return before, but you didn't claim the election, and now you want to claim the election, as long as it's a timely filed amended return, the existence of a tax liability or not is irrelevant, and your foreign earned income exclusion election will be valid. Form 2350, talked about that earlier. When you move abroad and you want to claim that you are a qualified individual either because of the bona fide residence test or the physical presence test, Form 2350 is the one that you use. So what you do, the part on the form above this is the normal stuff, what's your name, where do you live, and all that stuff. But this is the operative stuff. You say, I request an extension of time until a date that you get to choose to file my tax return for calendar year 2019 or other, blah. All right, so what date should you put in there? Answer is, I put in there a date that's 30 days after the date I expect the person to satisfy the bona fide residence test or the physical presence test. And that works. So, and the rest of it you fill in, your answers there. And so this might mean that you have a very long extension of time to file. You do want to pay, of course, so you don't have interest charges and all that fabulosity, but this will work just fine. And my recommendation, if you're doing one of these things, is, for God's sake, do the draft tax return and be ready to go, so that once that 30-day window clicks, you're ready to file promptly. But this works. Now, these last few slides are just the words and the reference to the regulations that give you all the rules that I talked about. When can you file and make a valid election? So here it is, for each of these. The important one, here's the reg for original return. So a non-filer coming to Jesus, filing late, more than a year late, and owes tax. You win if you file before the IRS discovers your failure to make the election. So go fast. Amended tax return, again, there's the reference to the regs there. And there we go. Thanks so much for listening. Really appreciate it. We do this, as I said, once a month, second Friday of the month. Next month is going to be May 15, 2020 is going to be the date, noon Pacific time. And the topic will be Form 5471, all those fabulous categories of filers, and the constructive ownership and attribution rules, and how you figure out whether you're a filer or not. So, good times. If you're not already on our mailing list, go to hodgen.com/newsletter, sign up, and you'll get advance notice of this. We also send out PDF copies of the slides and any materials along with it to people who register or get on the list, so you can get more stuff that way. And if you're not on the list, well, you got to be on the list. That's all. Just tell your friends. Anyway, thanks so much, and see you next month. Bye.